Genmab just delivered a pretty decisive beat on Wall Street's Q2 2026 consensus estimates.
Yeah, they really did. And it wasn't even close.
Right. So actual revenue hit $1.155 billion, which is up 25% year over year. That easily cleared the estimates of $1.12 billion.
And look at the earnings per share. Non-GAAP EPS came in at 54 cents.
Crushing the expected 37 cents. That is a massive 45.9% surprise?
Exactly. With GAAP EPS landing at 49 cents, it's a huge beat.
It is. And management even raised their full year 2026 revenue guidance to a midpoint of $4.425 billion, and they lifted adjusted operating profit guidance by 7%.
But, and this is the wild part, the stock reaction was completely disjointed.
Yeah, so shares initially surged over 8% in Europe on that upbeat guidance, but then U.S. ADRs actually closed down 1.88% at $28.71.
Right. So if you're looking at your screen wondering how a company posts a massive 45% earnings surprise, blows past revenue estimates, raises guidance, and, still ends the day in the red, you're looking at the ultimate profitability paradox.
Totally. The market basically spent the day stripping away those headline numbers to digest the underlying debt from a massive acquisition, plus some very specific looming clinical risks in their pipeline.
Yeah, Wall Street hates uncertainty even when the top line looks incredible.
Exactly. So for the retail investor listening in this deep dive, we're pulling directly from Genmab's Q2 earnings press release, the live earnings call transcript with the C-suite, and a stack of post-earnings analyst notes.
We need to break down exactly what drove this revenue beat, right?
Yes, and we're going to examine the contradictions sitting in their profit margins, management's highly aggressive strategic shift, and those specific trial risks that drag the stock underwater by the closing bell.
Because to understand how Genmab beat expectations by such a wide margin, you really have to look at the two distinct engines driving that 25% top-line growth.
Right. It's almost like an investor's portfolio. You've got your massive, reliable blue-chip dividend paying the bills, and then you have your high-growth tech division taking aggressive market share.
That is the perfect analogy. You have the legacy engine and the growth engine. So starting with the legacy engine, this is entirely anchored by Darzalex,
Which is their foundational treatment for multiple myeloma.
Exactly. And the financial mechanics here are just crucial to understand. So Genmab invented the drug, but Johnson & Johnson commercializes it globally.
Right. They do the heavy lifting on sales.
Yeah. And in return, Genmab collects a tiered royalty of 12 to 20% on those sales. In just the first half of 2026, those royalties handed Genmab $1.306 billion in pure cash flow.
Wow. And Johnson & Johnson just raised its own net sales estimate for Darzalex to a staggering $16.7 billion for the year.
It's a machine.
It really is. Even when you account for the fact that Genmab's royalty check is reduced slightly by, payments they owe to Halozyme for drug delivery tech and some minor patent expirations, the sheer volume of cash being generated is massive.
Oh, absolutely. And then you add in the Kesimpta royalties from Novartis.
Right, which brought in another $259 million in the first half. You just have this incredibly durable financial floor.
And that legacy royalty revenue is essentially funding the entire transformation of the company. I mean, it allows them to fuel the second half of the equation, which is the growth engine.
A high-growth tech division, so to speak.
Exactly. This is driven by their proprietary portfolio, specifically Epkinly, or Tepkinly as it's branded in Europe. This drug is just aggressively taking market share.
Yeah, the numbers are wild. Global net sales for Epkinly surged 48% year over year to $312 million in the first half.
And it was up 28% just sequentially from the first quarter.
Which is insane growth. And Genmab actually records those sales directly in the U.S. and Japan, which made up about $242 million of that total.
And what's really fascinating about Epkinly is the science driving the sales, because it's a bispecific antibody.
Right. And for anyone holding this stock who isn't a molecular biologist, a bispecific antibody is basically an engineered protein that combined to two different targets at the exact same time.
Yeah, it's pretty incredible technology.
It is. In this case, it grabs onto a cancer cell with one arm, and then it grabs onto an immune T cell with the other arm. It physically drags your body's immune system directly into contact with the tumor to destroy it.
And that precise mechanism of action is exactly why it just hit a major regulatory milestone. I mean, it is now the first and only bispecific-based therapy approved in Europe for second-line follicular lymphoma.
Which is a big deal.
Huge deal. Follicular lymphoma is a slow-growing type of non-Hodgkin lymphoma, but it's notoriously prone to relapsing.
Right.
So getting a second-line approval means that, as soon as a patient's first treatment stops working, doctors can just immediately pivot to EP-kindly.
Which opens up the addressable market significantly. And when you combine that accelerating market access with TVDAC, which is another proprietary drug that brought in $84 million, the overall proprietary portfolio grew by 37%.
Right, so just to recap what we have here.
Yeah, let's lay it out.
You have top-line revenues surging by 25%. You have a proprietary portfolio growing by 37%. And you have gross margins sitting at an almost unbelievable 93%.
93%.
Right. And here's the paradox. The stock closed in the red.
Why?
Well, the reason for that red close is this massive chasm between adjusted operating profit and the JAP reality.
Okay, let's dig into that. Because adjusted operating profit rose 18% in the first half. But Q2 GAAP net income actually fell 9.8%.
Yeah.
And if you look at the entire first half of the year, GAAP net income just collapsed by 33%.
That drop is the direct result of the Merus acquisition. So Genmab made this massive strategic bet to acquire Merus and its pipeline of oncology assets.
Right, but they took on $5.5 billion in debt to finance that deal.
Exactly. And when a company carries that kind of leverage in a high-rate environment, the interest payments act as a massive gravitational pull on net income.
I'll say. That debt generated $174 million in first-half interest expenses alone.
Just in interest.
Just in interest. And that's before you even add in another $77 million in specific acquisition and integration charges that are, just dragging down the bottom line.
And that integration also created a really bizarre tax anomaly that confused some people.
Oh, yeah. The effective tax rate reported for the first half was unusually low. It sat at just 3.6%.
Right. During the earnings call, CFO Anthony Pagano had to specifically clarify that this was due to deferred tax assets created by the Merus integration.
Basically, accounting rules allow them to use certain financial losses or expenses from the acquisition to lower their taxable income today.
Exactly. But Pagano noted this will take 12 to 18 months to normalize. So these GAAP numbers are going to look heavily distorted for the next several quarters.
And that distortion is what algorithms and, frankly, institutional investors really struggle with, isn't it?
Oh, 100%. They see collapsing GAAP net income and heavy debt servicing, and they just trigger sell orders. But taking on $5.5 billion in debt fundamentally transforms the balance sheet.
Right.
The underlying cash generation, that 93% gross margin and the billions in Darzalex royalties, that provides a massive safety net to service the debt.
So the core business is still highly profitable.
Exactly. The risk isn't default. The real risk is that the debt limits their financial flexibility moving forward. They're now highly levered to the success of their pipeline. They cannot afford any expensive clinical failures.
Okay, I have to stop you there, though. Because framing $174 million in interest expenses in just 6 months as a manageable shift in flexibility, that feels entirely too generous.
You think?
That is a structural hemorrhage of cash.
Yeah.
How can management justify stepping on the gas with heavier clinical investments when they are bleeding that much cash just to service the Merus debt? Is this structural drag, or is it just, temporary financial indigestion?
You call it a hemorrhage, but look at the operating leverage they are actually achieving. CFO Anthony Pagano highlighted their efficiency metrics, and they are objectively impressive.
How so?
Well, management raised revenue guidance by 5% and operating profit guidance by 7%, but they only increased their investment guidance by 2%.
Oh, wow.
Right. They are funding aggressive clinical expansion without blowing up their SG&A, their selling, general, and administrative expenses.
So they're actually doing more with less.
Exactly. CEO Jan van de Winkel explicitly stated they are staying disciplined with capital allocation while maximizing the medicines they've already commercialized.
And we actually see that commercial execution playing out in real time with EP-Kindly. During the call, Chief Commercial Officer Brad Bailey pointed out a really critical shift.
The community setting stuff.
Right.
Yeah.
EP-Kindly's U.S. uptake is accelerating specifically in community settings. It is moving out of those specialized major academic hospitals. He noted that over 90% of their key customers are now ordering the drug for 2 or more clinical sites.
And for a retail investor tracking this stock, I cannot stress this enough, the shift into community oncology is the most important commercial metric you can watch.
Why is that so critical?
Well, think about it. Major academic medical centers, places like MD Anderson or Memorial Sloan Kettering, that's where complex, high-risk, early-stage drugs are administered.
The patients require intense monitoring, right?
Exactly. But 80% of cancer patients in the U.S. are treated in their local community clinics. They don't want to travel 3 hours and stay overnight in a hospital.
No one one does.
Right. So if a biotech company can prove their drug is safe enough and the administration protocol is easy enough to be given in a local community setting, the addressable market just explodes.
It proves the drug can actually reach patients where they live.
Exactly. And that secures long-term revenue durability.
But management isn't just pushing the commercialized drugs into new settings. They are aggressively expanding the pipeline itself.
Oh, big time.
Yeah, Chief Medical Officer Ty Yamadi announced 2 new phase 3 studies for petosemtamab in colorectal cancer.
Ah,
And they are not taking the easy regulatory road here.
not at all.
No, they're targeting patients who are RAS-RAF wild type, and they are going head-to-head against the current standard of care, which is cetuximab, combined with chemotherapy.
And running a head-to-head trial against the standard of care is basically the ultimate high-stakes gamble in biotech.
It really is.
To understand why this matters, you have to look at the patient population. RAS-RAF wild type basically means these patients have tumors where the RAS and RAF genes are not mutated. They're quote-unquote normal.
Right.
And the current standard of care, cetuximab, only works well in patients without those mutations. So Genmab is purposely choosing the exact patient population where the existing competitor drug is strongest.
That's a massive flex.
It is, because if they win this trial, they completely rewrite the global treatment guidelines and capture the entire market. But if they lose, the drug's commercial value in this indication goes to 0.
Wow.
It shows immense confidence in the early clinical data they've gathered for petosemtamab.
Okay, so let's zoom out for a second. We have surging top-line revenue. We have incredible operating leverage, doing more with less. Management is successfully pushing drugs into massive community healthcare settings. And they are running confident, aggressive phase 3 trials.
Yep.
So if the commercial engine is humming along this powerfully, why the caution? Why did the stock close in the red?
Well, the market caution really comes down to the binary, unforgiving nature of clinical trials and, honestly, a looming make-or-break fourth quarter.
The clinical hangover.
Exactly. The market is currently suffering from a lingering clinical hangover. Investors are still operating with extreme caution following a recent miss on the phase 3 EP-core DLBCL-1 trial.
Right. Specifically, that trial missed its overall survival endpoint in the U.S.
And in the oncology space, overall survival, or OS, is the gold standard.
Right. A drug might shrink a tumor temporarily, which they call progression-free survival, but the FDA, and more importantly, the insurance companies paying for the drug, they want to see that the drug actually extends the patient's life.
Exactly. When a high-profile trial misses that overall survival endpoint, it casts a long shadow over the rest of the pipeline. In biotech, you are only ever as good as your next data readout.
And Genmab has a lot of readouts coming up.
Ton. Management has confirmed that Q4 of 2026 and Q1 of 2027 are going to feature this massive bonanza of trial data. The market is basically holding its breath right now.
Because of the Merus debt.
Right. This company has $5.5 billion in new debt, and they need these trials to hit to justify that leverage.
The upcoming schedule is definitely packed.
Yeah.
So in Q4 alone, investors are waiting on EP-candidate line, frontline DLBCL data, petosemtamab frontline head and neck data, and Rina-S platinum-resistant ovarian cancer data.
That's a lot of catalysts packed into 3 months.
And interestingly, the petosemtamab second and third line head and neck data was actually pushed from Q4 into Q1 of 2027. Management stated this was because the trial is event-driven.
Now, event-driven is a term that often spooks retail investors, right?
Yeah.
Because they automatically assume a delay means there's a problem with the drug.
Right, like the FDA stepped in or something.
Exactly. But in oncology trials, an event typically refers to a patient's tumor progressing or a fatality. The trial is designed to end only after a specific number of these events occur, so the statisticians can finally compare the treatment group to the control group.
Oh, so ironically, if the drug is highly effective and patients are responding well and living longer without the disease progressing, it actually takes much longer to accumulate the required number of events.
Bingo. So a delay in an event-driven trial can sometimes be a subtle signal of strong efficacy.
That's fascinating.
But Wall Street hates uncertainty, and they really hate waiting.
Well, they're also operating in a brutal competitive landscape. Genmab faces intense pressure in both the bispecific antibody space and the ADC space.
Yeah, ADCs are everywhere right now.
Right, antibody-drug conjugates. For those listening, they are essentially guided missiles. They use an antibody to find the cancer cell, and then they deliver a toxic payload of chemotherapy directly into the tumor, basically sparing the healthy tissue.
Every major pharmaceutical company is pouring billions into ADCs right now. So Genmab needs flawless trial execution to capture market share against competitors with, frankly, much deeper pockets.
And the Merus acquisition was supposed to solidify their position in this exact landscape, bringing in next-generation bispecifics and ADC candidates. But again, the market is currently fixated on the cost of that acquisition rather than the assets it brought in.
Yeah.
Honestly, I am going to challenge the market's reaction here.
Yeah.
Because looking at the data, Wall Street's logic seems completely myopic.
You think they're overreacting?
I do. They're laser-focused on one missed overall survival endpoint in a single trial, and they are heavily punishing the stock for the short-term integration costs of the Merus deal.
Right.
But they seem to be completely ignoring the fact that the proprietary portfolio, entirely separate from the massive Darzalex cash cow, just grew 37% year over year. I mean, punishing a company for investing heavily in its pipeline when it is already generating billions in high-margin cash flow, it just feels like missing the forest for the trees.
It's the classic tension between institutional timelines and fundamental business building. Wall Street operates on a strict quarter-to-quarter basis. They see $174 million in interest expense hitting the balance sheet today, and they penalize the stock immediately. They see one missed clinical endpoint, and their analysts instantly discount the future revenue models.
But management isn't playing a quarter-to-quarter game.
Not at all. Genmab's management is playing a 5 to 10-year game. They bought Merus to secure the next decade of pipeline assets. They are shifting epicunly into community settings to build a durable, unshakable commercial moat.
Right. Wall Street is reacting to the immediate financial cost of the construction, while management is focused on the finished building.
That's exactly it.
Which brings us to a really provocative final angle for you to consider if you hold this stock.
What's that?
Well, if you step back and look at the totality of this earnings report, Genmab is currently undergoing a massive fundamental identity shift.
Oh, absolutely.
For years, they were a relatively low-risk, quote-unquote, royalty collector. They executed brilliant foundational science, sure, but they relied on massive pharmaceutical giants like Johnson & Johnson and Novartis to actually conduct the global trials, sell the discoveries, collect the cash, and just send a royalty check back to Genmab.
It was an incredibly lucrative, low-overhead business model. I mean, they didn't have to carry the massive expense of a global sales force.
Right. But today, they are transitioning into a fully integrated global commercial powerhouse.
Yeah, they're doing themselves.
They are running their own massive, highly risky Phase 3 head-to-head trials against established standard of care drugs. They are building out their own direct sales forces for EP-Keenly in the U.S. and Japan.
And they are carrying $5.5 billion in corporate debt to acquire entirely new scientific platforms.
Exactly. So if you were a retail investor who originally bought Genmab stock for that safe, reliable, blue-chip Darzalex cash flow, you have to ask yourself, does this new higher-risk, higher-reward business model fundamentally change your original thesis for owning the stock?
That's the million-dollar question, isn't it? The company you researched and bought 5 years ago is simply not the company you are holding in your portfolio today.
It's totally different.
They have traded the immense safety of pure high-margin royalties for the heavy financial leverage and massive upside potential of direct commercialization.
Yeah.
The Darzalex royalties provide the safety net for sure, but the future valuation of the stock entirely depends on their ability to execute as an independent commercial entity.
It's a muddy, complex financial reality full of aggressive top-line growth and heavy bottom-line debt. But we will be tracking all of those make-or-break Q4 catalysts closely as the data rolls in. Be sure to follow the show for daily earnings coverage as we continue to break down the numbers that actually matter.